Today, we will look at updates in the space of rates, FX, and the property sector in Singapore with the OCBC Global Markets Research and Strategy team. We're extremely privileged to have with us Francis Cheung, Rates Strategist, Christopher Wong, FX Strategist, and our Credit Research Analyst, Wong Hong Wei. Let's start with interest rates outlook. Francis, what is our latest view on the Federal Reserve's policy rate?
Yeah, so after our upward revision to oil prices forecast and to US GDP forecast, we have also revised our Fed Fund rates outlook accordingly. We now expect 3 Fed Fund rates cut, 25 BP each instead of 4 cuts for this year. Our baseline assessment is that the broader disinflation trend remains, so does the Fed's easing agenda. However, some interim bumps in inflation would mean that the Fed is not going to cut interest rate just yet. And a delay in the timing of the first rate cut would just naturally means that the room for rate cuts in total between now and year end would be less. Of course, there are two-way risks to our baseline scenario, with the policy rate decision highly data dependent.
What about the implications on the rates and bond markets?
So market has already pared back a lot of its rate cut expectations, and US yields also adjusted higher across the curve. After all this market adjustment, we think there may be some factors which could lend some support to US Treasuries. First, on energy prices or oil prices. If oil prices stay high or rise again, I think that would be fair to assume that at least that is partly due to geopolitics, which shall result in some safe haven flows to Treasuries. If energy prices ease, then that would add back some dovishness to the market. Second, after all this market adjustment, now that financial conditions are getting tighter again, that would also work back towards the Fed's easing agenda. And third, QT taper may come soon, as signaled by the latest FOMC minutes. So over the medium term, we continue to look for a gradual lower interest rates environment. Of course, in the interim, we may need to always brace for some short-term market volatility. And when it comes to the implication on Sing dollar rates, whether it is the rising rate scenario or a falling rates environment, Sing dollar rates are likely to be more stable than US dollar rates. So before US dollar rates embarked on a more sustained downtrend, and with MAS still keeping the Sing dollar near slope positive, we would expect Sing dollar rates and US dollar rates differentials to remain deeply negative. That means Sing dollar rates would stay meaningfully below US dollar rates. However, in a falling rate scenario, our medium-term view remains for front-end Sing dollar rates to underperform, which means that the falls in Sing dollar rates are likely to be less rapid than the expected falls in US dollar rates. So on balance, over the course of the year, we would expect Sing dollar rates to grind gradually lower.
Okay, thank you for sharing. So with that in mind, what are the implications on FX?
Well, indeed, we revised up our dollar forecast in light of this change in some of these market developments. I think the first one is that we have a change in the Fed profile, and this high for longer narrative is going to stay with us just for a little longer. The next factor is how the disinflation progress in the US is now lagging expectations. So on that note, the CPI divergence with the rest of the world is resulting in a deepening of the monetary policy divergence with some of the major economies such as Europe, UK, and the Swiss as well. So that monetary policy divergence will have impact on the dollar. The next is we also factor in some degree of geopolitical risk in light with what's happening with the broadening conflict involving more countries. We have also factored in the persistent softness in Japanese yen and the renminbi, and that has impact on the Asian currencies due to the trade and sentiment linkages. That said, the upward revision in the dollar forecast does not affect our downward trajectory over the forecast horizon in the medium term. We still expect the dollar to trend slightly lower towards year end as we do look for the Fed to begin a rate cut cycle. Now, a disinflation trend that is more entrenched in US and a slower activity and labor markets will nudge the Fed closer to a pivot, and that should help the dollar to trend lower towards year end.
Moving on to Hong Wei, given what the two of them have shared, what are some of the implications on the credit market?
Given that rates are currently still high, it is good news for the credit market. When we look at the Sing dollar bond market last year, 2023, it returned about 7.6%. Year to date 2024, it has returned about 1.5%. The reason is because the yields on the bonds are still high, and so they are still returning well. Some of the parts of the markets that did a bit better are the subordinated issues. This is because some of them are structured with resets, and in the high interest rate environment, if the issuer does not redeem or call back these perps, they will be reset to a higher rate, and this will benefit investors. The other reason why in a high rate environment, the Sing credit market is doing well is because issuers are willing to issue. They don't want to lock in the interest rates when they are high. And as a result, there's fewer supply in the market. And with lower supply and with investors demanding more yield, these instruments, these bonds, will naturally outperform.
I see. So what are some of the impacts on the Singapore property market?
For the Singapore property market, it still remained quite resilient. In 2023, property market rose by 6.8%. In the first quarter of this year, it still rose by more than 1% quarter on quarter. What this means is that despite the rates going up, it did not impact the property market as much. Part of the reason is because for the Sing rates, especially from what we heard from investors, it did not go up by so much as compared to the dollar rates. Another reason is because in the Sing property market is largely anchored by homeowners rather than investment property owners. Most of them are genuine buyers willing to buy even though rates have gone up a little bit. I still see upgrader demand and be supported by resident growth, especially from new citizens and PRs. For the Sing property market, I'm still expecting the prices to move up this year in 2024, forecasting a rise by 3 to 5%.
Okay, thank you so much for all your insightful sharing.